What's up everyone, and welcome back to Explain the Charts. Today, we're taking a deep dive into Apple, symbol Apple, which is currently sitting at a fascinating crossroads after a powerful run-up. We'll cover the recent news driving the stock and then break down exactly what the charts are telling us about its next potential move. First, let's talk about the news, because there's a lot happening that is directly impacting the price. The biggest bullish catalyst by far has been the iPhone 17 launch. Reports from multiple sources, including Bank of America and Wedbush, indicate exceptionally strong demand for the new models. We're seeing extended shipping times, which is a classic sign that initial sales are robust. This has led analysts like Dan Ives at Wedbush to raise their price target to $310, citing a pent-up consumer upgrade cycle. JP Morgan also boosted their target to $280, pointing to favorable early demand. This positive sentiment was the primary driver for the stock erasing all of its 2025 losses in late September. However, it's not all positive. A persistent cloud hanging over Apple is its perceived lag in artificial intelligence strategy compared to rivals like Google and Microsoft. Concerns about talent retention, with key researchers leaving for competitors, have added to this narrative. Just 4 days ago, Jefferies downgraded the stock, sounding the alarm over what they see as unrealistic expectations for future iPhones. Furthermore, broader economic news is mixed, with the recent government shutdown and a weak private jobs report creating some uncertainty for the market as a whole. We also saw Berkshire Hathaway trim its position in Q2, which, while minor, can make some long-term holders nervous. Even so, Apple remains their largest equity investment by a wide margin. So we have a classic battleground: powerful product cycle momentum versus long-term strategic concerns and some recent analyst caution. This push and pull of news is precisely why the stock has stalled at its current level. Now, let's bring up the daily chart and see how this narrative has played out in the price. Looking at the big picture, we see a dramatic V-shaped recovery from the April 2025 lows around the $169 level. That $169 area serves as our ultimate long-term support for this entire multi-month rally. A major turning point was this massive gap up in early August, which occurred on reports of a $100 billion investment announcement. The stock then entered a period of consolidation for about a month, building a base of support in the $230 to $235 range. This consolidation set the stage for the next leg up, which was ignited by the iPhone 17 sales news in mid-September. The price then surged higher, breaking through previous resistance and heading straight for the all-time high. This brings us to the most critical level on this chart: the resistance zone between $259 and the 52-week high of $260.10, first set back in December of last year. The stock has now tested this exact level multiple times in the last 2 weeks and has failed to break through convincingly each time. This is creating a potential double or even triple top pattern, which is a classic bearish reversal signal that traders are watching very closely. The price is currently hovering just below this major resistance, coiling for its next big move. The recent pullback over the last couple of sessions is a direct result of this overhead supply. Bulls who bought lower are taking profits and bears are initiating short positions, betting that the resistance will hold. This is the most important battleground on the long-term chart. A resolution here will likely dictate the trend for the next several weeks, if not months. Let's zoom in on this recent action since the iPhone launch started making headlines around mid-September. You can see the explosive move that began on September 19th, the day the iPhone 17 officially went on sale. Notice the massive increase in volume on September 22nd, when the price surged over 3%. This high-volume buying pressure confirms that institutions were piling in on the back of the positive sales data. The price then ran directly into that wall of resistance at $260. We saw a rejection on September 25th, another on October 3rd, and it's been struggling below it ever since. This repeated failure to break higher is a significant technical event. It shows that for now, sellers at the $260 level are overpowering the buyers. Switching over to the 1-hour chart gives us a clearer view of the short-term structure. We are clearly trading within a defined range. The ceiling, or resistance, is that formidable $259 to $260 zone. On the downside, we've established a solid floor of short-term support in the $254 to $255 area. This level has been tested multiple times over the last week and has held up. A break below this $254 level would be the first sign of real weakness and would likely lead to a deeper pullback. For now, the price is simply bouncing between these two key levels, which is a state of equilibrium and indecision. Finally, looking at the 15-minute chart for today's intraday action, we can see this battle playing out in real time. The stock opened around $256.80, tried to push higher, but was quickly rejected. It then sold off to test a low of $255.60, right in that hourly support zone we just identified. We saw a slight bounce off that low, but the price is still struggling to regain any upward momentum. This price action confirms the key levels we've discussed: resistance at the session highs and support in the mid-$255s. Volume today has been fairly average, suggesting neither side has taken firm control just yet. Alright, to recap and look ahead, let's put it all together on the daily chart. Your most important resistance level to watch is the all-time high zone of $259 to $260.10. For support, your first key level is the short-term floor at $254 to $255. If that breaks, the next major support area is the prior breakout point around $245. Below that, the $230 to $235 zone offers another strong level of potential support. Now for some unbiased predictions. I believe the bullish scenario has about a 60% likelihood right now. The fundamental story of the iPhone 17's success is incredibly powerful, and as long as the broader market holds up, the path of least resistance is often higher. This scenario is reinforced if the price can hold above the $254 support and make a decisive, high-volume break above $260.10. If that happens, a move toward the analyst targets of $280 becomes very plausible. The bearish scenario has about a 40% likelihood. The technical formation of a triple top at an all-time high is a serious warning sign that should not be ignored. This scenario becomes much more likely if we see a firm break below $254 on increased selling volume. That would open the door for a pullback to the $245 support level. What to watch for? Keep a close eye on volume during the next attempt at $260. A weak volume push is likely to fail. Also, monitor any official sales figures or updates on the AI front, as these will be major catalysts. Finally, a quick disclaimer: this analysis is for educational and informational purposes only and should not be considered financial advice. Trading stocks involves risk, and you should always do your own research and consult with a financial professional before making any investment decisions. If you found this breakdown helpful, please hit the like button, subscribe to Explain the Charts, and let me know your thoughts on Apple in the comments below.